Hey everyone, welcome back to Chipstock Investor. We're going to be talking about ServiceNow, one of our top picks for 2024 that we never bought.
We've covered ServiceNow actually for years, and we've been content to own it via Vanguard IT, ETF, VGT, but we changed that. We now own shares of ServiceNow directly.
We'll focus on these three key points in the video. What is ServiceNow and why did we decide to actually add ServiceNow to our portfolio? We'll talk about the momentum they're getting in the agentic AI era and the forever concern over valuation.
Can't shake it. We're talking about enterprise software stocks.
ServiceNow had a pretty epic run in 2024. At the beginning of 2025, reached all-time highs over $1,200 per share. And we started nibbling somewhere in February. As it kind of started to pull back just slightly, we took our first nibble and we've been building our position in ServiceNow since then.
And why now? Now, let's review what the company does. In our hierarchy of the economy chart, ServiceNow fits somewhere in between infrastructure, modern software-based infrastructure, and ultimate product and service for end users. And specifically, what does it do? It is a workflow management software platform. So this expands all sorts of things like customer workflows, industry workflows, especially in IT. That's where ServiceNow got its start. So companies building software, managing software, and its development and operation use ServiceNow extensively to make sure tasks are getting done in a timely fashion. Lots of automation embedded in this platform, and they continue to expand what they do out from this base.
Historically, Salesforce has been the CRM leader, but Gartner has also added ServiceNow to the Magic Quadrant in CRM, or customer relationship management.
Yeah, big data, data management, especially for large enterprises, getting more important. And so this is a good fit for ServiceNow. They think that they can add something different to the CRM marketplace. So in a nutshell, this is why we added ServiceNow now to our portfolio. Let's briefly run through some of the financials and especially the guidance for this next fiscal year, 2025.
Q4 2024 results, they were absolutely fantastic. Their subscription revenue accounted for about $2.9 billion in the quarter, which was a 21% increase year over year. And then on an annual basis, subscription revenues made up $10.6 billion, a 23% year over year increase.
Now, as for 2025, management guided for about 19% year-over-year growth. Definitely implies a slowdown from 2024. Do bear in mind, there is about a 1 percentage point expected headwind from currency exchange rate effects. The US dollar has strengthened against a lot of foreign currencies. And so when ServiceNow exchanges those sales into US dollars, they do lose a little bit when making that exchange to USD for reporting purposes. You can see that shown here in this table that they put together showing the guidance 18.5%, 19% for the year, but excluding the impact of that currency conversion, we're still looking at a 20% and possibly more than that growth rate. ServiceNow does in typical software as a service company fashion, under promise and over deliver. But in addition to that, there are some new things in the works that we think could push that growth rate even higher for ServiceNow in especially not just 2025, but especially in the next 5 years or so.
Let's move on to our second point in talking about their agentic AI agents. Earlier this year, ServiceNow unveiled their new agentic AI to solve the most complex enterprise challenges. Basically, they're using these agents to help businesses manage their workflows, make it more efficient. Now, this custom service from ServiceNow was announced in January. They have a ServiceNow Agent Studio where you can design your agentic agent for your business and deploy those agents within your software and workflows.
And if you're wondering what agentic AI is in the first place, here's the slide that we put together a couple of months ago when discussing this, when we were talking about Salesforce and UiPath in particular. There's a number of software automation technologies floating around out there. One of them is RPA, robotic process automation, that just kind of takes care of repetitive tasks like filling in data on a form. But AI agents have a bit more autonomy, a bit more flexibility in what they're able to do. But it does require a company connect that AI agent, that software based bot, to be connected to the company's data so that it can go out and perform the tasks that the business programs it to do. Now, we've been covering ServiceNow for a few years, especially as they have a partnership with Nvidia, continuously improving their AI and automation platform. And then Nvidia uses it in turn to automate and increase the efficiency of their processes in designing new GPUs, new accelerated computing, and software libraries. ServiceNow really leaning into this, and it looks like they'll be making an acquisition to speed up this new business.
ServiceNow announced this acquisition just a couple weeks ago on March 10th. They're acquiring the company MoveWorks. MoveWorks is a front-end AI assistant and enterprise search technology. Adding MoveWorks to the software suite will help with the adoption of agentic AI.
Now, if I'm not mistaken, the price tag on MoveWorks was something like $2 billion. Pretty hefty price, especially for an AI startup. Where is the money coming from for that?
We can take a look at the very healthy balance sheet that ServiceNow has with the help of our friends over at FinChat. Total cash and short-term investments in gray, long-term investments in blue make up just over $10 billion on the balance sheet and a very small amount of debt, nearly $1.5 billion in debt. So ServiceNow has plenty of cash to purchase a small company like MoveWorks.
Yeah, this is exactly the type of balance sheet you want to see for a fast-growing software business, making moves to disrupt the status quo.
Agentic AI and AI in general in enterprise computing is especially important these days, as you very well may know. And CEO Bill McDermott stated that the International Data Corporation is estimating that AI platform software is going to be over $150 billion by 2028, with a nearly 41% CAGR during that period. ServiceNow has decided to add a new part of the business, a new model for the business in regards to their pricing. They've been solely on subscription pricing, but now they're having some additional features with consumption-based pricing. We discussed this about a month ago over on Semiconductor Insider. So if you want more discussion, in-depth discussion on companies like this, make sure you check out Semi Insider.
Yeah, part of Semi Insider, you get access to all of our research, the complete breakdown of businesses that we do deep dives onto. More importantly than that, we think, in our opinion, we provide an in-depth look at our top-down methodology when analyzing a business and whether or not it fits into that framework, if it's worthy of our investment dollars. Lots of discussion on this over there. We have weekly live Q&As, and we're getting ready to fire up some training sessions on how to do more in-depth analysis on businesses like that. Check it out, Semi Insider, just $10 a month.
Link in the video description below. Let's round out our discussion with that point number 3. ServiceNow has always seemed a little too expensive. What about now?
Yeah, but this is not unusual for a fast-growing enterprise computing business. This is another thing we talk about extensively over on Semi Insider. A lot of different metrics you can use to judge the efficiency of a software-based business like this. But let's just look at the 1-year forward price to earnings and price to free cash flow multiples. They have come down during the recent market correction, about 51x expected price to earnings on a GAAP basis, just over 41x on a free cash flow basis. Now, these are high multiples, but again, this is not unusual or unexpected for a business growing about 20% or more. And in addition to that, importantly, not just the revenue growth, but profit margin expansion. ServiceNow has been able to deliver that over the years, especially under Bill McDermott. The company has done a fantastic job of steadily increasing the profit margin. So now we don't expect this valuation to hold for forever, gradually over the next 5 to 10 years as the business continues to grow, as the growth rates gradually slow down. You would expect to see a natural decrease in those valuation multiples. So even with that taken into consideration, though, about 20% revenue growth over the next 5 to 10 years with a bit of profit margin expansion baked into that each year, we thought the stock was a good opportunistic add for our portfolio at this time. So that's why we finally did it and pulled the trigger.
Thanks for watching this episode of Chip Stock Investor. Make sure you sub to the channel, like the video, share with your friends, and again, check out Semi Insider. We think it's a great value, and we can talk more about ServiceNow. See y'all soon.